Will China's loss be India's gain? China's Jiangsu province plans to close 9 chemical parks, making an opening for Indian exports to take the lead in the global market. Varun standing by with more details of that. Varun.
Morning, Abha. So it's already been a trend in all over the globe as far as the chemical market is concerned. China continues to shut down and curtail operations of chemical plants. Now what's happened is, in a recent development just yesterday, 1,400 chemical units will be shut down in the Jiangsu province. Now this will be following up on what's been a trend here with China's blue sky policy. China underwent huge pollution problems and in the recent past, and as far as 2015, the blue sky policy came into effect. Now what this did was said that operations need to be curtailed, and the Chinese government had to increase or accelerate investments in ETP. Now, ETP adds a significant cost structure to any chemical company. It means that all hazardous waste products that are generated from these units need to be treated in-house before they are sent out to the public. Now, Chinese agrochemical and chemicals market overall is around $1.5 trillion versus India's 150 billion. So the production is 10 times that of India's. And China's global market share in the chemical sector is around 34%, while India's is just 4%. So with foreign policy easing and the government increasing incentives for foreign chemical companies to come here, 15% tax for any foreign entity, and we've seen a tax rate cut benefit coming into other chemical companies, it should augur significantly for more investments into chemicals domestically. We've also seen with the US-China trade war picking up pace, there's been a preference in India as a supplier for these chemicals, and now the 15% export revenue which China derives from the US, which is a massive $250 billion, larger than India's entire chemical market in total, can now be tapped by Indian players. So you should see a huge benefit across the sector. We've already seen Indian chemical companies growing much faster than the global comps. You look at UPL, Aarti, SRF, all the big names, tremendous growth. The Indian growth CAGR is around 13-14%, which is twice that of other companies. You also have companies like UPL and Arista, which are now Indian companies forming one of the top 5 global agrochemical giants in the world, a clear signal of consolidation within the Indian industry. So all in all, margins are also expected to expand significantly going forward. Margins have been superlative for Indian chemical companies in the recent past. Companies that were trading at an average of 14, 15, 16% EBITDA margins have seen 19, 20, and 21%. Now, there needs to be an ecosystem that's cultivated around this as well. So we have some managements coming up later this morning, which will talk more about what the industry needs to do to really set things in place for this big growth.
Yes, and exactly that's what we're going to do. Let's welcome on board Rajendra Gogri, the chairman and MD at Aarti Industries, joining in on the show right now. Rajendra, hi, morning. Let's begin by you talking about the current predicament for chemical companies in China and what exactly has transpired there over the last few years, creating this kind of disruption.
Yeah, last few years, basically the entire environment protection related issues have been tightened up in China, and a lot of industry have been told to move to different location, and which is a twice impact. One is a short-term impact, which creates disruption and spikes in the prices. And long-term impact is basically the both capital cost and operating cost in China will increase. So that is as far as the cost is concerned. And because of this uncertainty, there is a more demand pull also from India. So India has got currently advantage both on the demand side as well as the cost side.
Right. You know, the cost structure for Chinese companies seems to have changed forever. Higher investments in ETP and relocation of plants seems to have added costs, making Indian companies more competitive. Is that true? And if so, will this turn out to be advantageous for you? And how long will this play out, really?
Yeah, if you see the last 10 years now, the Chinese labor cost is double than Indian labor cost. So that has expanded the margin in last few years structurally for Indian companies, for the existing companies, and for the other company, the product which were not competitive for Indian companies in the past, they have become competitive, and we have seen a lot of increase in chemical manufacturing activity in India. A lot of products which we had to export in China before, they are being consumed in India. So structurally, the margins have expanded for Indian companies.
Okay, now 4 years ago, the turnover for the industry was probably 150 billion US, which is a tenth of the Chinese. With the industry now growing at 13%, what's the kind of opportunity size you feel is up for grabs?
It is up to the capacity of Indian companies, I think. The pie is big. Only thing, is how each companies are able to expand and develop the product and put in the market. So it will be basically R&D and the projects which will become the bottleneck, not the demand as such. And we see that more investment also coming with this new announcement on tax front on 15%. That will kind of accelerate the investment by Indian companies, as well as maybe some multinational also may be able to come to India.
Also, the US-China conflict creating an opportunity for domestic companies, again, in terms of, Chinese chemical exports to the US are pegged at about 250 billion. Do you see a mass migration to India, the government lowering taxes as well to 15% for foreign companies? Do you see MNCs setting up shop here?
Yeah, I think definitely, in general, I think the companies who are exporting from China because of this trade uncertainty and which may continue to be longer, they would like to have more manufacturing in India, make India as a manufacturing base for a non-Chinese market. So that trend also we are already seeing this kind of signs. And this reduction in tax will accelerate because we have to start the plant by March 23. So entire process will get accelerated, decision making and everything by the foreign companies.
Okay, and how important will be the availability of raw materials in order for this? Do you see any problem in sourcing, particularly RMs, due to the China shutdown? How are companies going to survive that?
Yeah, that is, might actually lead to more manufacturing of those raw materials if possible in India. Otherwise, time to time, those disruption will have an impact. But generally, you don't see that a total long-term closure of particular raw materials.
All right. Thank you so much for joining us then and taking us through your views.